What's going on, everyone? I just wanted to quickly walk you through my previous trade that I took in the S&P a couple of days ago. As you can see, I entered the position here on the 12th, and I took out what's called a debit spread. It's also called a put spread. It can be called a bear put spread. Now, a debit spread is when you pay a debit in hopes of your premium increasing. It's like the cliche buy low, sell high. So I was able to pay a debit of 46 cents. But of course, when it comes to options, depending on how many contracts you're controlling, right now I'm controlling an equivalent of 100 shares. One contract is 100 shares. So you multiply this by 100. I set a limit order at 48 cents, but I was able to get filled at 46 cents to my benefit. That's actually one of the amazing benefits of the Tastyworks platform. It will give you the best fill price possible. I closed it out 6 days later, which was yesterday, the 18th, and I collected a credit of 70 cents. So I paid 46 cents and I collected 70 cents. Now, a put spread, a bear put spread, is I'm betting that the stock price is going to decrease. I was able to short the S&P 500. It's actually just the SPY ETF, not the actual S&P 500. But I was able to short it at 252. And a bear put spread does consist of two contracts, two legs. It's going to be one short put and it's going to be one long put. The reason I took out this position is because I was defining my risk. Because let's say if the stock price were to increase, I would have been assigned 100 shares of the SPY ETF and would have had to come out of pocket $25,000, which isn't best for my portfolio at this moment, especially with the chaos that's happening in the market. I don't want to be assigned shares at a higher price. Now, a bear put spread or put spread, in this case, like I said, I didn't want the stock price to decrease. The S&P, the SPY, the SPY 500 ETF Trust, it is trading at 242 right now. So of course I needed that to stay below my 252 mark. Another reason why I took out a debit spread, so when you pay a debit, you're buying, is because of the recent hype and spike in volatility. The spike in volatility, the expansion, it also benefited, my position also benefited from that. Right now, IVR is at 79.4. Typically, if you're trading in the Tastyworks way, they do advise if anything above, say give or take 30, but anything above 50 is ideal. You want to sell because premium, prices, it shows the prices of the options are a little bit higher. So when you're buying a debit spread or when you're paying a debit, you want volatility to expand. So with the combination of the price declining, which I wanted to, decreasing, and also with volatility, IVR continuing to expand, that helped out my position. I want to walk you through something similar, just in regards to another trade. I want to place it here before the market closes. So what we're going to do, I am looking at SPY again, but I want to see let's see if we can get into like Bowen. Obviously Bowen has taken a hit. What hasn't taken a hit nowadays? IVR is at 96.10. All of the talks with the bailout, I'm certain that volatility may continue to expand in this case. So I'm also, bearish, I do think the price is still going to continue to decrease just a little bit. But let's see what their table is looking like. Here's the options chain. Like I said, it is going to give you a couple of days that you can decide on where you want your contract to expire. I want to see what 43 days are like. So the bid and ask spread, it's very wide. This spreads are very wide. So that means this market is illiquid, meaning that I may not get a fill. You never want to get into a market that's not liquid, because if you were to get in, your chances of getting out will be slim when you need to collect your profits. So even 21 days, still a little skimp. So 15 days, not a lot of volume. So what I'm going to do is I'm going to go to another company here. Let's see what Delta Airlines is looking like. Delta has been going through a lot lately as well. I'm surprised their stock price, man, is at $20. IVR is at 189. Good Lord. Looks like they have earnings coming up April 8th. They may miss that mark because of all the, everything that's going on. They had to put their fleet a little bit more, like 70% of their fleet on the sideline. So I already know they'll probably miss some of the earnings calls and whatnot. And volume here isn't what I like it to be either. So let's see. What about Bank of America? Let's check out Bank of America. Bank of America is at 21. They also have earnings coming up soon. So I like this here. 5 cent wide, bid and ask spread. So that lets me know that markets are a little liquid. Now, I don't know if I want to be, I think I'm going to go neutral on this one. Actually, I'm not going to go neutral. I'm going to short this. I am going to try, let's see what a butterfly looks like. Now, a butterfly, I'll be able to set a limit on where I would think the stock price is going to go, and I can eliminate my risk to the downside. So as you can see here, as long as the stock price stays below 24 bucks, and even if it continues to drop, I eliminated all of my risk to the downside. I have a 71% chance, probability of profit, right? My theta, I'm collecting this daily because I'm collecting a credit. Now with the credit, time is on my side. So as each day goes by, my premium is going to lose this every day, and I want it to lose that. Right now, my delta is a -6. So I'm equivalent to shorting 6 shares of Bank of America. So I do need that stock price to decrease because I am, eliminating my risk to the downside. As you can see here, as long as the stock price doesn't go above 24 bucks, I am golden. So when you are putting on this type of position, this is called a broken wing butterfly. I want to try to collect more of a credit. So I'm gonna set it here. So I didn't get filled right away. So what I'm gonna do is try to mess around with some credits here. Let's see if we can get filled. So we still didn't get filled there. Now sometimes it does take time. It may not be instant in most cases, but you see how it bounces around here. And these are just some of my previous positions from earlier. And you see how the price just bounces around. So right now I have it set where I want to collect 8 cents. Now, of course, you got to multiply that by 100. But here we see that I can possibly collect 10 cents. So go to 10. Let's see if we can get it at 10, which I doubt, but hey. But yeah, so basically this is what it consists of, placing these trades here. And man, the market in this case, this is my first time experiencing something like this while trading options. I wasn't trading options in 07 and 08. But, it's good to really see how beneficial it is to trade options. And, a lot of firms, or, a little bit more of your advanced traders, they are taking certain positions like this to protect their portfolio. They can use options to reduce their cost basis. Let's say, for instance, if you buy 100 shares of an underlying, for instance, like if you did Bank of America right here and you were to buy 100 shares at the market price, which is $20.96, that person would then go to an options chain and they would sell a call at 20 bucks to protect their position. They would reduce their cost basis. What they would do is they would collect $320, right? So they would collect that $320. So that would subtract. You can take that from the amount of money that you would come out of pocket for the $2,000, just in regards that you come out with 100 shares. Now I'm not going to put that position on. This is just an example. But this is another way where you can protect your portfolio in the future. If anything were to go against you, it would look like this here. But let me delete this because I don't want to get too confusing or whatnot. But you see how this price is bouncing around. The mid price right now is at 5 cents. I may get filled in at 5 cents because it's less, but actually I haven't. Let's see what open interest. Let's see what the volume is at. That can also be a problem too. I mean, it's a pretty good volume here. Anytime the open interest and volume is above 1,000, it's a pretty good liquid market there. Open interest is the amount of contracts that's currently open. Volume is the amount of transactions that were taking place for those strike prices. And the strike prices, you'll see them here. Okay. I'll definitely keep you posted. I'll let you know where I got filled. I'm actually going to go back to 7 cents, and hopefully I can get filled before the market closes. What I'll do is I'll follow up with another video to let you know if I did get filled. But let me know what questions you have. Like I said, it was just a brief just explanation on my recent position in the S&P. But right now I am going to try to collect some credit in Bank of America. So hopefully IVR, implied volatility, hopefully that doesn't continue to expand, because that would actually hurt my position even if the stock price were to decrease. Thank you for your time. Let me know what questions you have. Follow and subscribe to my YouTube channel. I'm going to be posting a lot more videos. I appreciate your support, and have a good one.